Perhaps you're wondering why we are two presenters for this presentation. So the reason is that Emmanouil kindly asked me, we both work on the Market Infrastructure Directorate at the Bank of England, and Emmanouil asked me whether I could give some overall presentation about why his work, jointly with Gareth, is important in the area of CCPs and stress testing. So what I'm going to do is to give a general introduction to the context in which this work has an important impact in terms of financial stability. So this is the usual disclaimer, just to make sure that we are not breaking any sensitivity rule. So on the first part, which is the one I'm going to talk about the general problem of central clearinghouses. So some of the things I was planning to say have been already very well explained by Andrea, so I'll skip them. In general, when we talk about clearing, it could be happen either on the OTC or on the centrally cleared side. But in both cases, we're talking about a series of processes in which there are some accounting processes, but there are also some an important part which has to do with managing counterparty credit risk. So, in general, when we talk about clearing, we talk about an operation that happens as part of the post-trade cycle. Once the trade has been agreed between the counterparties through an exchange or on a bilateral basis, then there's a series of processes that go after that, which are named as clearing, which involve some type of risk management, of counterparty risk management, and some sort of accounting, making sure that both sides of the trade have the right amount of assets to go on with the trade. The particular thing that comes when we talk about central clearing has to do with the fact that instead of having a bilateral operation, the central clearinghouse takes on board all the counterparty credit risk of the members that are participating into the system. So in the simplest case, in a bilateral trade where you have a buyer and a seller, then of course the buyer has assumes the risk of the counterparty failing, and the seller assumes the risk of his counterparty failing. When the CCP comes into the game, the CCP places itself in the middle of the trade, so it becomes the buyer for every seller and the seller for every buyer. So the idea of the CCP is to take away the counterparty risk from the bilateral participants and have the responsibility of managing that counterparty credit risk. This process is called novation. So where we initially have one contract, we end up with two different contracts on each side of the CCP. And as one of the diagrams that, perhaps this is very small for you to read, but the general idea is that, as in one of Andrea's diagrams, the fact that the CCP interposes itself between buyers and sellers not only is a way of managing risk, because now the CCP is in charge of guaranteeing the trades for both parties, but it also has the advantage of bringing multilateral netting benefits. So where we initially have bilateral trades, now we have trades which can offset against each other. So the amount of flows between the different participants is substantially reduced. So one of the important things when we think about central clearing is the netting benefits. This is, for example, particularly important in the case of assets like swaps, like interest rate swaps, because they have long maturity. So if I am a bank and I'm trading a portfolio of swaps with a particular clearinghouse, then the more I trade with that clearinghouse, the more it's convenient for me because I get more benefits from offsetting positions. So there's a natural tendency to kind of monopoly structures in the CCP world because of the multilateral benefits that central clearing brings to the picture. So why, from the perspective of regulators and from financial stability, why are CCPs important? Well, they're important, first of all, because they concentrate a lot of counterparty credit risk, but also they bring transparency to the system. And when after the financial crisis there was this big decision by policymakers of pushing all clearing into central counterparties. The idea was, among other things, to bring more transparency to the market. The bilateral OTC world is opaque, or was very opaque, and there was an important push into moving all these trades into the central clearing, where you have more visibility about who's trading and what are the sizes of the exposures involved. Another important thing is that the CCP is supposed to be a node in the financial network, which is very stable and very resilient, and therefore it will be a kind of a shock absorber in case of financial stress. So to the extent that CCPs perform this role, we would expect the system to be much more stable and more resilient. But of course, the important thing here is that we need the CCPs to be well prepared and well risk managed in order to perform that function properly. So I think this is perhaps the central diagram I want to mention before passing to Emmanouil. How does the CCP guarantee its resilience against counterparty credit risk, in particular against the default of a member? So the CCPs have what is usually called a waterfall structure, a default waterfall structure, where we have different levels of defense. So the initial defense is based essentially on initial margin, which is what we've been talking about. So each one of the clearing members has to collateralize their portfolio, their exposures, based on the amount of risk that they bring to the CCP. And this is where the margin models come into place, where the CCPs have to measure that potential future exposure, that the portfolio of a member has. The idea here is that if the member defaults, then the initial margin should be able to cover any losses during a reasonable period of time. And that reasonable period of time, which goes somewhere between 2 and 5 days usually, is supposed to be the time that the CCP will need, once a member has default, to either liquidate the portfolio or hedge the portfolio or auction the portfolio. In other words, when a member defaults, the first thing that a CCP will do is to try to neutralize the portfolio, in other words, to neutralize market risk, to hedge the portfolio, and once the portfolio is hedged, they will try to either auction it among other members or liquidate the portfolio in order to get rid of it and pass it to a different clearing member. So that's the way the default management works in the CCP. In principle, that's the strategy. Sometimes they have additional elements to cover, for example, for concentration or to cover for settlement risk, and these are margin add-ons. And they usually do this process of margining, calling margin from the members on a daily basis, usually the end of the day, but almost all the CCPs currently, because of new regulation and new standards, have also to monitor and to call and have the ability of calling intraday margin. Now the question is, well, when I measure the potential future exposure, I'm setting a risk appetite. I'm saying, well, if I'm using a VAR model, for example, I would say I want to cover my losses up to a 99.5 confidence level. But of course, this means that I am not covering all potential events, but I'm stopping short from the tail events. So the question is, well, how do I manage situations in which my model was not calibrated to the conditions of a stress market, for example? So the next line of defense that a CCP has to cover those situations is the default fund. Now the default fund is different from the initial margin in two aspects. One is that it is a mutualized resource, so it's a pool of money that the members contribute to in different proportions according to the risk they bring to the CCP. So that's one difference. And the other difference is that it is not calibrated with the same model as the model that's used for the initial margin. And these default funds are calibrated using stress testing. So they are based on a set of stress scenarios that the CCP chooses. They apply the stress scenarios, they stress the portfolio of the members, and then they choose those situations in which losses are biggest, and they use those situations to calibrate the size of the default fund. According to the European regulation, for example, they have to choose the two largest losses under stress scenarios, and then that will be the size of the default fund. And another important difference of the default fund is that it won't be used until the collateral of the defaulter is being exhausted. So it's really something that mutualizes risk, and from a systemic perspective is important, because if a member defaults and its losses are not bigger than the initial margin, then let's say that the crisis is limited to that particular relation between the clearing member and the CCP. But if the initial margin is not enough, so if for some reason the losses are bigger than the initial margin, then the CCP will begin using the default fund. But the default fund is mutualized, so that's when the risk begins to be spread across the different clearing members. So sizing the default fund and the fact that the default fund has to be let's say, independent of the calculation of the initial margin is one of the important things in terms of ensuring that the CCP performs its job properly. After the default fund, there are still some extra layers of protection. So there's a capacity, for example, the CCP can ask the claim members to top up again the default fund, perhaps one or two times. And then after that, there are some probably other elements.
Can I ask you a follow-up question?
Yes.
It's basically directly, because the way you draw it, the terminal point on the right is a default of the CCP.
Yes.
What do the authorities see as acceptable PP?
Well, that's an interesting question. I think that
it's basically mass, basically from below the curve to infinity.
Yes, yes. So I think that in fact, our let's say our scenario is that the CCP does not default. That once you exhaust,
you can't have a non-defaulting CCP. I mean,
yes, you cannot have it, but you can have a CCP where you have the instruments to make it, even if it's defaulted from a solvency perspective, it's still working from a perspective of keeping the market functioning.
So, for example, I heard Theron Duffy give a presentation on exactly the same stuff. And he started by saying a CCP has a PD of once every 250 years. So he made that strong, saying exactly the same thing. So you're assuming the PD has CCP has a PD of 0.
No, I'm not assuming that. I'm saying that for the purposes of the different defense layers of the CCP, of course, you get with initial margin up to a certain point. You know that after that point you have the default fund. What comes after that? I think that's a question that comes into the recovery and resolution process. And that's more about finding out how to keep the CCP going in order to avoid a market disruption, even if you are in the point of default. So I'm not assuming that they don't default in terms of solvency. What the regulators are trying to do is to ensure that even if you get at that point, you can still get the CCP functioning to avoid the disruption of the market.
So what's the probability of each stage? What do the CCPs assume is that when the initial margin is exhausted, the DF contribution, resources, default fund? So what's the waterfall structure? In a typical
waterfall structure, I mean, 99% according to regulation, you end up with the initial margin. So your tail for the default fund is whatever comes after that 99%.
Daily?
Yes.
So basically 2.5 times a year?
Yes.
So basically 2.5 times a year, you're a defaulter that exceeds the dotted line. Then after you get to the second box, I'm just curious, what's the probability as you move to the right in a typical CCP?
So you have 99%, which means that every year you expect, if you have 250 days, you're expecting 2.5 days to get losses beyond that in your portfolio. But that doesn't mean that your your member defaults. So you have a member defaulting, and then it's when you have you could expect losses within that range. But it's not the 99% of member defaults; it's the 90% of the movement of the portfolio. So we can take it offline. What I wanted to stress is that the resilience of the CCP depends very much on the default fund. This is more or less what I've said: the importance of correctly sizing the default fund, and here is where the stress testing comes into place, because stress testing is the methodology to size the default fund, and according to the regulation, you have to include plausible extreme scenarios, which is somehow vague. And there are lots of things which have to be calculated in a consistent way. So the important thing from the work that Emmanouil will present now has to do with how to model these scenarios in a consistent way. So I'll pass it to you.
Thank you very much, first of all, for inviting. It's a great pleasure actually to be here and to present this work, which is obviously a collaborative work with Emmanouil and Gareth, who are both at UCL. And what we are trying actually to achieve with this paper is to show that scenarios that CCPs, for example, stress test scenarios that CCPs are using to size the default fund are important actually, and you should somehow be able to cover a spectrum of different scenarios in order to be able to make sure that the funds that the CCPs place aside above the initial margin estimates are enough to cover potential losses in case of default of clearing member. So this is the overview of the paper, so I'll try to motivate you why it is important actually to take into account multi-curve dependencies. I'll provide a methodology, a case study, and I'll summarize. So as all of you probably know, stress testing is a very useful exercise. It's getting more and more important nowadays for quantifying the size of potential losses and for identifying the scenarios under which losses might occur. So as financial regulators, we define the stress event as an extreme but plausible scenario in the market that the portfolio is exposed to. But how really we can define what a plausible scenario is? In CCP space, most of the stress testing exercise involve historical calibration, so they don't necessarily use a model to produce some stress scenarios of the risk factors that the CCPs are exposed to. So they based actually the calibration on using historical data, and this doesn't necessarily give the whole spectrum of potential different outcomes. So in this paper actually we focus on yield curve stress testing using a multi-country framework, and we attempt actually to answer the following two questions. How we can associate market-wide and country-specific liquidity and credit concerns with cross-country yield spread dynamics. We know that both liquidity and credit components are important when you talk about credit spreads, so we want somehow to relate the stresses in these particular components and we want to identify how the stresses of these particular components might generate some spillover effects in the yield curves we study, and how we can generate consistent stress scenarios across countries. So when I say consistent, I refer to the fact that, as I said, stress testing is typically, especially at the CCP space, we use stress testing at the individual level, so we don't really take into account the cross-market dynamics. So we calibrate the scenarios for each particular curve separately. So somehow we don't associate curves. Curves move over time, and you can have some spillover effects between different curves. So we want actually to accommodate that within our framework. There is a wide range of stress testing. We refer to CCP stress testing. They use it to size the default fund. Obviously, stress testing is quite important for banks. They set capital requirements. They use stress testing to to analyze sensitivities of the portfolio. So there is a huge range of stress testing, and stress testing is getting more and more important with new regulatory requirements like Basel III, for example. This is a graph taken from this is a histogram taken from BIS 2005 survey. This is a bit old, but this is a way actually to motivate you why interest rate stress testing in particular is important. As you could see here, 60 of the banks participated, reported stress testing on interest rates. This is 3 times more than the stress testing they use in credit or foreign exchange or equities, and 10 times more actually the stress testing that they use in commodities. So stress testing interest rates is quite important thing actually for a number of market participants, whether it's a CCP or a bank. So I would like to just introduce how stress testing could be alternatively done. So you could probably have a PCA methods. You extract some factors, and through these factors you are trying actually to generate some stress scenarios. The main drawback from this approach is actually that it's focused on a single curve analysis rather than a multi-curve framework. There are other drawbacks related with this approach. For example, there is no economic interpretation on the principal components. And then you have another class of models. They somehow use a similar analysis. The analysis that we want to introduce, they fit some dynamic state space models to capture the dynamic movements of the curves, and then they use some PCA methodologies to extract some factors, and through this they stress these factors and they generate some stress scenarios. But still, there are some limitations, and I think the main limitation is that this methodology is applied on a single curve basis. So in this particular paper, we focus on a multi-curve setting, as I said before, and we try to produce consistent cross-country stress test scenarios, allowing for spillover effects between the economies. So we try to model jointly the temporal and the cross-country dependent structure as a function of market-wide and country-specific liquidity and credit variables. So we use some variables to capture the credit risk, some other variables to capture the liquidity risk. And we believe that the model is flexible enough and can accommodate a number of scenarios. And the model also can be applied to different rates markets. We have applied this model on the yield curve space, but we believe that this model can be applied to different rates markets. And also the model can have some practical benefits. For example, can handle futures of real data, such as missing data or unbalanced data sets. So let me give you just an overview of the methodology and what we are trying actually to model here. So this is a snapshot of the 5 different curves that we analyze. So you have the Italian, the German, the Spanish, and the French, and the UK yield curve. So the model involves 2 steps. The procedure involves 2 steps. So in the first step, we fit for each particular country a dynamic procedure model augmented with macroeconomic factors. And so we estimate for each particular country a dynamic procedure model. And once we estimate the model and we get the residuals, we transform we rearrange the residuals and we model the dependence across different curves, but within the same tenor using a covariance regression model. And we express actually the movements of the residuals, the covariation of the residuals as a function of credit and liquidity factors. So we use bid-ask spreads and credit spreads to approximate liquidity and credit for each particular country and each particular tenor in this study. This is a flow chart just to show how the methodology can be applied in practice. So, as I said, there is a calibration element. So, the first step, during the first step, to estimate the model, rearrange the residuals, fit the covariance regression model, and then once you obtain the estimated parameters, then you can decide which factors you want to stress. So once you decide how would you stress these factors, so in our particular example, we decided to stress, motivated by the recent crisis, the European crisis, the liquidity and credit factors of the Italian and Spanish bonds. So once you decide how you stress that there are different methods that this can be obtained, you can end up to a new series of stressed covariance matrices. So this is explained in step 4. And using some transformation mechanism, you can back transform the residuals, and you can feed these new residuals into the common filter specification of the model of the first step, and you can rerun the filter actually based on the estimated parameters, and you can actually get a set of new rates, a new stress series. And since you have a distribution now, you have a new distribution, you can decide whether you want to apply a quantile and obtain a particular scenario. So when you apply, for example, the 99th percentile of the worst movement on this particular distribution, you can get a stress scenario for this particular country. So let me quickly explain to you the models. So this typical dynamic net model, we use as a 3-factor model because it's quite easy to understand, has been used widely in literature. Obviously, you can increase the number of factors there. We decided actually to keep it as simple as possible. We also included some macroeconomic factors. So the X vector actually contains a set of microeconomic factors. And this is a way as well to conditioning the sample to different events. So we want to make sure that the residuals that will be coming out of this model actually would be conditioned on this, on the social, on these macroeconomic factors. We estimate, as explained before, this model for this particular country. And once we obtain the residuals and we rearrange the residuals per tenor by country, and we fit the covariance regression model of renew. This small axis contains actually the liquidity, the country-specific liquidity and credit factors in our modeling framework. So in other words, we are trying to explain the covariation of the residuals, so the sigma, as a function of liquidity and credit components, country-specific liquidity and credit components. This is the full model specification. So with AIDS matrix, we are trying to capture the dependence across tenor. The tenor structure dependence will be sigma matrix. We try to capture the dependence across countries. As I said, we wanted to apply this methodology and see whether they produce some meaningful stress scenarios. So we use data downloaded from Bloomberg for these 5 countries: Italy, Spain, Germany, France, and the UK. We cover 13 different maturities. So I can try to capture the whole movements per curve. So from 1 year up to 30 years. So we use liquidity and ITRAX Europe index as measures of market-wide liquidity, a set of other macroeconomic factors, and we use bid-ask spreads and CDS spreads to approximate liquidity and credit factors for these particular countries. Then, as I explained, we need to decide how to apply the shocks. So we ended up with these 3 simple ways. So we decided to apply a shock to liquidity variables only, a shock to the credit variables only, and a combined shock. Obviously, there are a number of ways you can do that. This is the simplest way, so we just shift the curves by 1 standard deviation. There are a number of ways. My authors actually suggested a number of more statistically reduced ways you can do that, but we wanted to keep things simple. And obviously, you can apply the shocks. So we apply the shocks per each tenor separately, but you can apply these shocks simultaneously as well, and you can combine these shocks with other macroeconomic shocks. So, as explained at the beginning, there is flexibility it's up to a regulator, it's up to the bank to decide what kind of shocks they want to analyze with this framework. This is an annotated graph. I'm not sure how I can use this to play. What I want to show actually, this is the stress covariance matrix, so the colors change over time. To play. Yeah. Yeah. It doesn't matter. It would be a good opportunity actually to show people how when we apply the shock to this particular maturity, this is of the 10-year tenor, for example, when we apply the shocks and we generate a new set of covariance matrices over time, we would actually see how the colors are changing, how actually we change the dependent structure using the stresses to liquidity and credit factors. And this is yeah, okay. So now you can see actually the colors, and you can see actually how these colors change over time. So the darker lines, the darker colors refer to strong correlations, positive correlations, the blue to negative correlations. So we can play around. You could see actually over the crisis how colors are getting darker or darker blue. So we could actually generate a number of different covariance matrices, and we can fit this through to the model. We can actually generate a series of stress yields for this particular country. And this is how the correlation looks like over all the pair correlation for these particular countries over 10 structure. This is the 2 years. This is an annotated graph. I can't play it, but if I would be able to play this annotated graph, you could see actually that over time correlation changes. This is actually the most important for us to make sure that we could potentially generate completely different scenarios using this framework. The correlations that I was trying to explain before refer to residuals. There is no direct interpretation. However, once we fit these residuals into the model, we can generate, as explained before, a series of new stress yield, the new stress rate. So we could compute correlations between all of these possible pairs. So what you could see actually here is a smooth graph that shows us correlations. I smooth it just to be able actually to display the changes. So you have the no shock, so this is the historical correlations, and then the rest, the red, the green, and the combined actually refer to correlations that are coming out from the shocks that we apply. So what you could actually see here is that when you apply shocks at the short end of the curve, the shock seems to change correlation more than the shocks at the longer end of the curve. In this paper, we don't try to try to provide methodology, and we don't try actually to give qualitative arguments of why this can be done. There are many reasons that this can be done, but we don't provide qualitative arguments, but definitely, since we have a statistical model and we have incorporated these factors in a statistical rigorous way, we can test and we can, for example, find out which factors are important and not important. So somehow we can generate a selection procedure, and we can include the factors that probably are more important in explaining or generating the scenarios.
So after applying the shocks to the Italian and the Spanish yields, we can, as explained, we can generate, we could see how these shocks affect the curves of the rest of the countries. So I pick here actually the UK curve. So we apply the shocks at the 10-year maturity only, and you could see actually, since we are able actually to model the dependence on over the term structure. We could quantify how the shock at the 10-year tenor not only affect the 10-year maturity of the UK yield in this particular case, but how the shocks propagates across the term structure. So this is actually what you could see here. You could see that the shock has provided more prominent changes in the UK yields at the 10-year maturity, but you could also see how the different shocks affect the short end and the long end of the curve. And I present here how the shocks at 2, 5, 10, 20, and 30 years actually, how the distribution of the series actually when we apply these shocks to the Italian and Spanish at different maturities. So you could see, you could get a number of different stylized parts. So based on this distribution, then we decided to calibrate the scenarios of the 99th percentile and using a bond portfolio, we wanted to show how actually you can obtain stress losses in this particular case. So we use some bond portfolios for this particular countries, equally weighted, and we apply these shocks, we calibrate the scenarios, and then we price these portfolios, these bond portfolios apart, and then we assume that the shock happened. We have already calibrated the scenario, so we know the change in the yield, so we can reprice the portfolio and we can plot the change in the value of the portfolio. So this is how the portfolios looks like, the distribution of the portfolios. When you apply different scenarios, you could see that the Italian and the Spanish portfolios have been affected the most, as you would expect, but there are some cases actually, other portfolios, different countries, to be affected using our methodology. We believe that this model can not only be used for stress testing, but could be potentially used for other risk management purposes, for example. So what I have done here is, since we have a time series of, so you have a historical series, which is the red line, and then you have a series of, you have a new stress series coming out from the model when you apply a shock to liquidity, credit, or a combined shock in this particular case. So we thought that collateral haircuts might be a potential opportunity for this model. So normally, when CCPs, when you place collateral at the CCP, they normally apply haircuts. So they reduce somehow the market value of the portfolio of the bond to make sure that when there is need, when you have to go in the market to liquidate it, you won't be the market of the market value of the collateral won't be affected by let's say fire sales. So somehow they use VAR or expected shortfall measures to set this collateral, to set these haircuts. And in this particular case, I just use a historical VAR at the 99th percentile to estimate the theoretical, let's say, haircut level that you could use if you were a CCP. This is just a simple exercise. There's nothing to do strict reality. So this would be the red line, how this red line would evolve for this particular bond. So this is Spanish government bond at 10-year maturity. And then I recalculate actually these haircut levels after applying actually our methodology, after applying the shock to liquidity and credit and combined shock to Spanish and Italian. And you could see actually how these levels could be substantially different, especially during the period of the crisis. So potentially this model could be also used for collateral haircuts, or even for calibrating a stress bar. So there is now a concept you might have been, you might have came across. So there is now a tendency risk models to move to a stress bar environment. So you need a period to calibrate, a stress period to calibrate your model. This somehow involves some stress series. So this could be another potential use of this model. Let me summarize. So we developed a multi-curve modeling framework that allows yield curve modeling, stress testing in a consistent way. And we believe that the model is flexible enough and can accommodate different scenarios. And the model allows for qualitative and quantitative assessment, as explained before. And we believe that the model can be applied not only to yield curve space, but possibly to swaps, to model different swap curves and generate scenarios. And we, from the qualitative point of view, but still it's a work in progress, so we don't want to comment a lot on that. We have seen actually the liquidity and credit shocks have generated significant spillover effects between the economies, and these effects can be substantial, but vary across time and across term structure. And we believe that the methodology can be also used for setting collateral haircuts, for example, or in the concept of stress bar I described before. So this is how it works. Yes.
I think it's quite a nice environment you have for doing the stress tests. What I was just trying to follow your mathematics, and I'm sure maybe in a paper or something. So
yeah.
Two technical questions for you on this.
Okay.
So the first technical question is, when you calibrate it, how do you guarantee uniqueness of solutions if you have multiple solutions?
Multiple solutions on what?
When you calibrate.
When I calibrate the first part of the model or the second part?
Yeah. The first part.
So I think it's pretty standard, right? So it's so we use the Kalman filter to estimate the model. So I don't understand why this is a problem.
Okay. Okay, so you end up with a unique solution, because I've seen implementations like this where you end up with multiple solutions.
So when you refer to multiple solutions, so if you start with different starting values, maybe you end up to...
Yeah, okay, fair enough. We can talk about this later. The second question I had for you was, if I understand it correctly, you're looking at this as a sequence of static scenarios, basically a particular time period you're stressing, right?
Yes.
Now, one might think that, for example, if you stress one country or one part of this domain, it's going to have multi-period spillover effects.
Yes.
So there's a dynamic resolution of the stress event.
Yes.
Is that something that I think you could probably easily comment it? Is that, have you looked at this? Or?
No, I haven't considered that at all. So we're just focusing now on the methodology and how this could be used in practice. But what you would suggest actually to look at?
We can talk about it.
So in concept, could have a dynamic impression of how the stress factors change through liquid variance regression.
So basically, I'm thinking about, so if you stress a model in one time period, then it will spill over. I'm thinking about it like a vector autoregression type framework.
You could build that into the factor of how you, when you build a regression model.
Exactly.
Parameters are static, and then how you adapt covariates.
No, but
this was a simple static case.
But that will also affect the calibration, because then you're only looking at the ultimate outcome and not the beginning. Okay.
So it depends on what filtration you want.
Exactly.